Hello everyone, hi and welcome to the channel of Wall Street Mojo. Friends, today we are going to discuss a fantastic topic that is called primary market. Well, when we talk about primary market, what is the first thing that comes into a picture is when a company wants to issue their shares in the market, that is in the public, then that's known as public issue. So this is the first time when the company is coming out in public and asking for money from the shareholders to run the business. This is in a very crude language if we are talking about. So as you can see, the primary market is divided into a couple of parts. The one is public issue, which happens at the very first time when the company is coming out with its first issue. Then after the private placement, after this there has to be follow-on public offer. There is FPO, that is known as follow-on public offer. Then the private placement comes, which is known as qualified institutional placements, and post that this is preferential allotment, which is known as preference shares allotment, and rights issue, which is sort of a grant which is given to the existing shareholders. If they don't want to take those shares, then they can renounce those shares to the outside shareholders. So in this fashion, the primary market is divided. So what are primary market? See, most of the large scale growth and development activities of entities such as companies as well as government need to be financed by raising external capital. See, majority of the companies, you can say expansion work, growth level, if they want to do, and if they don't want to get into the deep hole of debts, then they can go out in public and they can ask money from there. So this is basically external capital that comes in various and simple as well as a complicated forms, and the whole process is basically been performed by an investment banker who acts as an underwriter in this particular scenario. Apart from taking loan from financial institutions, an entity needs to issue some kind of financial instrument or security like stocks or bonds. So such thing helps a lot, because at the end of the day, stocks, bonds, and in case of bonds and in case of loan, you are liable and there is a front end liability. But in case of the stockholders, the shareholders, they are the last one to receive at the time of the liquidation. So it is easy for the company to issue such shares. But at the end of the day, primary market, you can say that it is a little bit expensive, because over there is a lot of expenses that are involved: legal expenses, investment bankers expenses, regulatory expenses. So it involves a much higher level of money over there. So as you can see over here, if we talk about the definition, in all, the primary market, is that part of the capital market where new securities are created and directly purchased by the investor. This is very important: directly purchased by the investor from the issuer. And creation of new security facilitates growth with the economy at the same time, because there is a movement of capital in the market. So once the security are purchased by the investors, they can be traded in the secondary market. So basically, the first time purchaser are the initial shareholders. When they feel like that they want to liquidate their positions, so they will sell their shares in the secondary market, where other shareholders will play among themselves and they will trade the shares with buy and sell activity which goes on, and that goes in NYSE or Nasdaq or maybe Nifty or Sensex in India. So raising capital in primary market can happen in one of the four ways. First is public issue, second one is right issue, then the private placement, and the preferential allotment. There is a follow-on public also offer also at the same time. As a term refer, companies issuing new securities through initial public offer is like going public. They're going to the public for the very first time. A large number of investors can purchase this newly issued security in the open market, and investment bankers, they play a very major role in this situation, because they help to raise the funds, they help to raise the money for the company by acting as an underwriter. Rights issue is an invitation basically to an existing shareholders to purchase additional new shares in proportion to their holding within a fixed time. Now, if this shareholders are not interested in purchasing these shares, then the company gives them a right to sell these shares, that is renouncing of the shares to the outside shareholders. The third is the private placements. Private placement refers to raising equity capital from the selected investors like venture capital funds, insurance companies, and HNIs, that is high net worth investors. Those are the people who take part in this particular process. Preferential allotment, it is the process by which allotment of shares is done on preferential basis. to selected group of investors. So they have a preferential right over the equity shareholders. So over here they act as an equity shareholder. Over here they get equity shares. Same over here, equity shares, but over here they get the preference shares, means they have a preferential right over the equity shareholders. Now, as we have noted about that, such markets where company can issue new security is to raise external capital, and investors get their first chance. Investor gets the first chance to get or to subscribe the security, and that's why it's called the primary market. The primary market is also known as the new issue market, because once again they are going out for the very first time. The company is going out for the very first time in the public for the share issue. On 6th May 2014, Chinese e-commerce heavyweight Alibaba filed a registration document to go public in US, and it is the mother of all initial public offer. Why it has been said? See, Alibaba's IPO was the biggest IPO in the history in the whole world, because it was close enough to $4 to $5 billion, $24 billion. So reading through Alibaba's S1 interesting educates and makes me realize that how big their business is and how complex is Chinese internet web. There is a full Excel based on financial model that you can download from Alibaba's financial model, which is available to you all. See, this Alibaba's IPO today, it is a successful company. Jack Ma, who is the CEO and the chairman of this company, he holds stake in Paytm, which is once again a fintech company. In the similar fashion, on 24th March 2014, an online storage company called Box filed an IPO and unveiled its plan to raise $250 million. So the company is in race to build basically largest cloud storage platform, and it competes with the large company like Google and rival Dropbox. So it was in a tough competition with those sort of people. See, what are the function of the primary market? See, as a beginner would wonder how the IPO is carried out, and initial price of a new security being issued is determined. So the answer of the underwriting groups, which facilitates the process for the issuer entity, the underwriter is an important entity in the primary market, because they carry out the functions like this ones. As you can see, underwriting, origination and distribution. So at the very first place, they underwrite, either it is full underwriting, that is firm's underwriting, or it is partial underwriting. It can be anything. It is just an agreement between the company and the investment banker. Then there is the distribution, then there is an origination and the distribution process. So as you can see, the underwriting group consists of the investment banks, and those investment banks are the major bulge brackets. They act as an agent over there, sort of a broker, you can say, and they act for a price determination for a given security and then oversee its distribution directly to the investors. So basically, the price discovery, the price determination is done on the basis of the two formulas with the two-way. Either it is a random price determination based on the demand of the HNI's investors or the top-notch investors, or second is by PE, the forward PE multiple X. With the help of that, the amount has been determined. So how is the underwriting process go about? As mentioned above, a company itself does not actually go out in the primary market to sell security. Rather, it requires one or more investment banks like JP Morgan, Morgan Stanley, Credit Suisse, Goldman Sachs. As you can see, these are all mentioned: Goldman Sachs, Credit Suisse, Boston, that is Barclays Capital, JP Morgan and all. So in most of the cases, it is a group of investment banks. If it is a large issue like, you can say, if it is a large issue like Jack Ma's company of Alibaba, then in that scenario, a syndication of bank works to come into picture for the issuance of such IPOs, because those are some of the really big IPOs and they really need to commit themselves over there to make the deal happen and make sure that the subscription is completely full. So how the deal arrangement and the commitment takes place? See, first over here, the issuer entity and the underwriting group, they meet and they enter into a deal which includes matter like amount of money the company will raise, the type of the security they are going to issue. There will be an agreement between them. So whatever may be the type of the deal agreed upon them, once the agreement is been done with them, a portion of the issued security from the entity is to sell to the public. And over here, once again, the syndicate group works and they may commit to guaranteed amount. So that is called the firm's underwriting or firm's commitment. and by effectively selling the issued securities to the investors. So in another type of commitment, the syndicate may not guarantee the amount that will be raised. So that's what I told you, partial underwriting. So it is dependent upon company to company, investment to investment bank, with how they want to go about regarding the issue. Now the regulatory issue. Whenever the regulatory issue come, in US it is SEC, in India it is SEBI. If it is banking company, then RBI comes into picture, Reserve Bank of India. So let's read in. The process of underwriting is in the primary market is time consuming, as I it is expensive, as I told you in the very beginning, and also exposes issuer entity to regulatory issues. Absolutely, they have to pass through humongous level of regulatory works, and they have to get it done. Until unless that is not done, the issue doesn't get cleared. So it is very important component of IPO, exposing a company's account books of accounts to public scrutiny, as well as to oversight the SEC. And in our scenario, it is in India, if we go to see, it is SEBI. So before anything else, the underwriters and the issuer entity, so the company in general, together take the regulatory hurdles. And the investment bankers are, once again, they play a major role over here for taking the responsibility regarding how the things are going to work out. So let's see what exactly are the costs involved. See, the first cost that is involved is the underwriting fee. Okay, underwriting fees is, it is a major cost, because it is the percentage of the direct issue, because the cost involved in the IPO and primary market includes majority of the fees charged by those syndicate banks, legal, accounting, distributions, mailing cost. So basically such costs are really heavy, and that stays in close enough to in between to 3 to 7%. So that is the amount of the issue, 3 to 7% of the issue. Well, after this, you can say Twitter. Basically, I wanted to give you an example of Twitter. Have you heard about it? Twitter, everyone knows it, everyone is there. Twitter went on public in 2013, and Goldman Sachs was the lead underwriter, while the syndicate group also included other underwriters like Morgan Stanley was there, and JP Morgan was there. So they charged close enough to about $59.2 million, and as for the fee of underwriting and for managing the sale, so that was around close enough to 3.25%, and of the total $1.82 billion which was been raised by the company. Now, another concept I want you all to learn is what is roadshow. This is very important. See, it is basically an event that needs to be organized by the issuer to the market, to market the securities to the potential buyers. So it is often called as dog and pony show. Why? I'll let you know. See, the road show is intended to generate excitement, that instinct, which is very important among all the shareholders, that the HNIs, that excitement level is important, and interest in the issues or IPO. So it's often critical to the success of the offering. See, in the event, the company's management, including like CEOs and CFOs, investors relation individual, travel across the country to generate excitement and interest among the analysts, so that there is a complete level of marketing in that particular end. And the analysts, the fund managers, the potential investors like institutional investors, the FIIs also, they also participate. So the event itself can cost millions of dollars. I'm not kidding, it really costs millions of dollars. Hence, entering the primary market is no doubt lucrative for the aspirations of the company's management, but it is very significant stage in company's life too. And it is an equally resource consuming process at the same time. Now, how is the price determination is been done? As I told you, the price determination is done with the help of two method. See, either the company goes out and the investment bankers, basically they do the book building process, they take out all the HNI's investor, they ask what are the demand, or what is the price exactly they are ready to pay, and based on that offering prices, they do some valuation work, and based on that valuation, the final price has been determined. So the first method is offering price method, and the second one is the forward PE multiple method, forward price earning multiple method, which is usually used. So usually they go for offering price, and apart from the 100% of the issue, the investment bankers also get 15% or extra as a green shoe option. for stabilizing the share price. So green shoe option is again provided by the regulatories for same. So now deciding on number of shares to be issued. See, firstly, it is very important to recall that before going public, a company is already owned by small number of people, and it includes like founding. There are like the promoter members, the promoters, which are known as the founding members, the you can say the venture capital and the venture capitalist and the angel investor, and the company often issues a small percentage of the ownership to its senior employees as compensation. So basically it so that so such that early employees also own some part of the company before an IPO. So for the sake of simplicity of the understanding, let's assume that this owners of the company hold certain different number of shares within them, sort of like different quantity of the shares equal to the total number of the shares that the company is made of. Now as the company needs to raise money and decides to go public, this owner needs to part with some of their ownership to the net owners. So for this, the original shareholders of the company needs to decide how much of their stake, very important, how much of their stake do they want to give away to fuel the company's growth by the investors' money that is going to come as a proceeds of the IPO. Now there are a couple of more points that we have to discuss is the advertising end and understanding the willingness of the institutional investors. Now let's see that. Now, the next thing that we need to understand is advertisement of the public offering to the institutional investor. So as I told you, the roadshow that happens, why the roadshow happens? See, it is basically not to create that interest for the small shareholders, but it is all about those kind of shareholders who are really big, the institutional shareholders that we are talking about. And basically, as you can see, they include like top pension funds, the mutual funds, the hedge funds, the high net worth individuals, I told you, HNIs. So they are the long standing clients, because the small investor, retail investor, won't be able to absorb the price fluctuation that could take place after the IPO. And as it is written, the most retail investor base their decision on unsophisticated methods that could lead them to their life saving by purchasing the stock in the unstable environment. So once this is done, we can determine now the understanding of the willingness of the institutional investors. See, after the roadshow, if once the roadshow, the institutional investor evaluate the securities that is being issued and decide upon how many shares they wish to buy. So they communicate their willings to the issuer. Remember I told you the offering price, this is how it has been determined. And in fact, they submit their request and not orders or bids regarding how many shares they want to purchase. And this request are often basically conditional. They are not on a simple terms. They are on the conditional basis, and they specify what kind of price they are ready to pay. In rare cases, they may not specify any sort of a price range, which is very important. So this request are processed basically to get a very rough estimate of the demand of the issue price of the issued security, and this task itself is a quite tricky, since in the total demanded number of shares is usually much more than the number of shares that is to be issued, that because there is a fear of rejection of the request, and most institutional investors tend to request a much higher number of shares than they actually want. So let's see what exactly is secondary market. See, once these shares that have been issued in the primary market, then all those shareholders who are there in the primary market, it will now, if they feel like that they don't want to hold the position, they will sell off to the secondary market. They will sell off the shares in the secondary market, and in the secondary market the shareholders will trade in on the stock exchange like NYSE and Nasdaq. See, the price is again determined at the stock exchange by Barclays Bank, for example. Like they are known as the designated market maker, which is known as the DMM, and the opening price is set to such that the number of trades that can be executed is maximized based on the number of orders submitted until that time. See, next, this share starts trading on the stock exchange at the opening price. Basically, remember one thing, they start trading at the opening price, and basically the orders are used for basically price discovery, which is once again a very important thing. And this completes the journey of the shares from primary market to secondary market, because at the stock exchange they are sold and bought by the entities other than the issuer itself. So let's make the final conclusion. Now the conclusion in our scenario is, see, securities are created in the what primary market. and they stay there for a small amount of time. So as they are sold at the stock exchange by the institutional investors who bought them during the IPO, but the primary market is extremely important for the company that has decided to go public. See, the price determination method is different from company to company, and it plays a major role. But at the same time, it is not different from the general concept of the demand and supply balance and perceived value of the offering, but it is equally resource consuming, as it is basically a product launch, you can say, and and it is worth it basically. So after all, the amount of money that the company is able to raise by going public is determined by how the primary market behaves. This is the most important thing, which is taught in the course of CFA as a behavior finance also. I hope you have got the best knowledge regarding the primary market and secondary market. Good luck everyone. Thank you.